If you're like many who wish to stay invested to improve your chances of reaching your financial goals, but you simply worry about the market damaging your portfolio, our solution is to hedge your portfolio when most advantageous. Recent results in 2018 and 2020, plus a COVID-driven tail risk hedge, have been highly effective and also have historical significance dating back to 1965. We'll show you more about this later in the presentation, but for now, let's move on to the problem.
Saving time, money, and sleeping well is obviously very valuable for most people. Let's take a look how we specifically achieve this. Before we dive into the presentation, 2020 has been an incredibly difficult year for many. Would you have been comforted knowing you had someone promising to protect your portfolio specifically when the market broke below that red matter area on the chart before you? This is precisely one of the tactics we do on your behalf to protect your portfolio. Obviously, a decline like this is on people's minds and is a problem presented in the marketplace. This is how we help you. Clearly, a bear market sustained or a crash can limit or even void financial goals. Let's just say that's suboptimal and you can do better. The average bear market decline was nearly 40% according to Goldman Sachs, but importantly took nearly 60 months simply to break even. The problem is actually twofold. Obviously, a bear market can be detrimental to your portfolio, but the future efficacy of bonds used as a traditional counterbalance to your equities is highly questionable to say the least. This is all related to how low interest rates are currently. Additionally, even when bonds work, you remain exposed. For example, the typical 60-40 portfolio structure during the last bear market took 3 years simply to break even. Again, you can do better. However, there is very real reason to be concerned about bonds counterbalancing equity declines going forward. This pertains to global central banks, the Fed in particular. In order for them to be stimulative, they need to buy more and more bonds. And just as you buy anything, the more of it as you buy, the prices increase. You can see this in the graph to the left. However, note below is the yield, which is inversely related to the bond's price. The problem is, with the 10-year bond, this is the global benchmark, with the 10-year bond sitting at half of 1%, it's already near zero. The question is, how much lower can yields go? Negative rates are possible, but they certainly are not the norm. If the U.S. global benchmark 10-year were to go negative, it would be indicative of an economy that went from bad to worse. If anything, the solution that we have would be even more needed. So let's get into that next. There are 3 possible solutions to approaching risk. First of all, an all-stock portfolio, where essentially you're simply accepting losses and the possible years simply to break even. That's not much of a solution. Secondly, is a diversified portfolio, that 60-40 structure you may have heard about, where you're investing less in equities or growth asset and putting some in bonds, which hopefully counterbalance equity declines. However, we have shown that this could be problematic in the future. Or thirdly, is adding on a hedging strategy. Now, a really nifty aspect of the hedging solution is that it takes a common problem and converts it into an opportunity. Okay, now that we understand what the problem is and the possibility or probability that it's actually a twofold problem, let's talk a little bit about the solution. Hedging is a process that mitigates or even eliminates downside portfolio risk. However, a constant hedge, you're not going to lose money in your portfolio, but you're also not going to make money. So something else needs to be added to the mix. To bridge this gap, we need to be dynamic, where we can tilt the scales in your favor. By increasing or decreasing the hedge, we can counterbalance downside equity risk, or simply remove our hand when all is clear. We use our dynamic hedge strategy to help know when to tilt the scales in your favor. In a nutshell, these are our best ideas for long-term investing, beginning from when the market is doing very well, in fact, too well, and enters a parabolic phase, all the way into and through a recession and onto a recovery phase. This is known as full business cycle investing. When successful, we can cut or even eliminate negative drawdowns. This reduces the time to break even, elevates a launch pad for any subsequent recoveries, and gives enhanced flexibility to seize opportunity when others panic. This is a very powerful position to be in. Additionally, it is possible that increasing return can be achieved by lowering your risk level. The portfolio paths of both a non-hedged and a hedged portfolio are in front of you. Take a note of the blue line on the right-hand chart, which represents a hedged portfolio. Note the vertical and horizontal axis. Vertical is value in terms of drawdown, and horizontal is time. The hedged portfolio will have a smaller drawdown and require less time to break even. Sometimes you can just see a storm coming. Likewise, do you protect your portfolio after a big drop or after a big gain? This is precisely what is meant by being opportunistic, contrasted with simply constantly hedging a portfolio, such as when a calendar flips, new month, new hedge. You can do better by being opportunistic. To compare and contrast hedging approaches, a constant hedge basically is saying a new month simply means a new hedge. It's mindless and it's costly. Tactical hedges are opportunistic, have agile effectiveness, and cost efficiency. This adds an enhancement to the investment process in a way for you that is not only unique and valuable, but perhaps timely given elevated economic uncertainty. Okay, in front of you, we're getting into the weeds a little bit. This is the sequence of events that we get to in order to protect your portfolio. On the far left, you have a strategy alert. It's a factor that occurs in the market or the economy. From there, we wait a signal. Usually, it's a market-generated signal to then initiate the trade. So we have an alert, then a signal, and then the protective trade. Okay, in front of you is an actual example of one of the factors we look at. In fact, it's one of the first hedging tactics that we do. Um, this is known as mean reversion, and when the market gets a little parabolic, it enters an extreme overbought zone, and from there, we look to enter a protective trade for you. And on the right, you can see the alert, trigger, and trade. Before we talk about the enhancement, let's take a step back and explain what is the same about the process. First of all, through consultations, we seek to determine what it is you're investing for, your goals, ascertain how long you have to achieve them, and what you're willing to tolerate to get there, known as your risk tolerance level.
This then dictates an asset allocation model for you. Asset allocation is that little pie chart you've probably seen a million times where it slices and dices up into respectively how much you put into stocks, bonds, real estate, commodities, etc. Now, the process up to this point is fairly cookie cutter. There's nothing amazing about this at all. And sadly, this is where most people stop. And what you're left with is a cookie cutter, static asset allocation model, probably with rebalancing. However, this is very much subjected to the whims of the market. That is not good, and you can do better. This is precisely where we step up. Our value added is proactive downside risk mitigation. Okay, let's do a compare and contrast. On the left is the typical investment process, and on the right is what we do. Picking up where most leave off, we extend this asset allocation model and we add on a hedging strategy. A hedge, by design, increases in value should equities fall. Okay, let's go over a visual. Here's a recent episode when the S&P got crushed, the hedging conduit increased. Stocks down, hedge up. It's like a seesaw. This isn't rocket science. In summary, what we seek to do is a very simple calculus. That is to build a diversified portfolio, add a hedge strategy for simply smarter investing. Of note, when we build your portfolio, we're using all the best practices. Cost efficiency, diversification, compounding, the entire list of goodies. So, a diversified portfolio plus a hedging strategy, simply smarter investing. One of the most effective yet super simple hedging tactics we do on your behalf is called hedge neutralization or portfolio neutralization. If you look at the graph in front of you, the concept is really simple. All we're doing is when the market falls below that red matter area on the chart, which represents the long-term moving average. In this case, it's the 195-day moving average. Uh, what we do when the market falls below that, we neutralize the equity holdings in your portfolio using options and futures. And the historical results of doing this have been really quite remarkable. There's going to be more information on a later slide and also on our website that lists some really key inflection points in the market. In front of you, this is 2018. The next slide is 2020, the COVID panic, which is very, very intriguing. Okay, so far we have gone over the hedge neutralization concept in 2018 and 2020 and shown that it's not only unique, but it's highly valuable. On the screen in front of you is a screenshot of our website to encourage you to use this resource. You can click on these little thumbnail charts and to investigate how useful this would have been in key episodes such as the 2001 top, 2007, surprisingly 1987 crash. Also, what's not on here is 2015 through 2016. But you'll also notice below is another graphic that shows from 1965 how this would have performed and how effective would it have been. So I encourage you to use this resource. It's quite fascinating. Okay, another type of hedging we do, a very specific type of hedging, is called tail risk hedging. Um, this is to hedge and protect portfolios against a very deep, sudden market panic like we've had in 2020, the COVID crisis. Specifically what we do, utilizing a lot of the same analytics for the dynamic hedge strategy, we look to purchase 15% out of the money puts on the S&P for a duration of about 2 months. Now, this has been very beneficial this year, in 2020, obviously. The graph in front of you probably speaks for itself. The percentages are correct.
And if you haven't noticed the post that I put up on LinkedIn pertaining to this before the drop, the links are on the slide in front of you. You can check those out. Okay, some notes pertaining to accounts with us. Your account would be held at Interactive Brokers. Interactive Brokers is Barron's top-rated broker this year. I believe the year before too. They have some of the lowest cost, widest array of products, best technology, and credit rating in the business. This is why we use them. We have no economic relationship with them, thus eliminating a conflict of interest. Um, Also, your account would be a SMA, which is a separately managed account. There's lots of bells and whistles that go with that, but predominantly you maintain full control with mobile and online access. Okay, in closing, I thought it'd be appropriate at this point to at least touch upon the wealth management process. We would begin by developing a customized financial plan utilizing some of the best software out there. This would be planning for various life goals, financial goals, such as retirement planning, college planning, that sort of thing. And from there, we would develop a fully customized portfolio for you to suit your needs, and from which you can decide to have that on a hedged capacity or not.
If potential market damage is a problem for you, and it is logically for most, we are here to help. We hate to see people lose money, and we would like to help you. If this win-win proposition is intriguing, let's start a conversation today.
Okay, thank you so much for your time and attention. I really appreciate it. If you have any questions or would like to start, feel free to reach out to me. We'll set up our conversation and see how we can help. After this, if you're interested in the process, I have some further information about that, as well as some other goodies for you to review. But other than that, thank you so much again, and be safe and healthy. Bye-bye.